Hello, YouTube, it's your boy, the Crazy Trader, and I'm here again with your favorite stock review. Like I always say, it's get money, don't make no money, and you always gotta risk it to get the biscuit. I'm not a professional financial trader, so don't take my word for nothing, okay? This is just for entertainment and educational purposes only. Do your own due diligence with every stock that I talk about. Today, I'm going to talk about something controversial that a lot of people are going to bash me about, but I'm okay with it because I'm just leaving this so that that one person who watches this video will take this advice and go with it because that's what I did to grow my account. So I'll show you something. Diversification is a way to sustain your account. It's just a way to maintain the money that you've saved in your. And now I'm very heavily diversified. That's why when the market was going down and crashing, my portfolio has stayed very consistent. It's gone down a little bit, which is fine from the all-time highs to now, which is fine. I knew that was going to happen, but I kept, I diversified in such a way that the consistency is fine because I told myself as soon as I passed the 100,000 mark, $100,000 mark, I'm going to diversify and keep my portfolio and keep that money that I have. And if I find a stock that I think is really interesting, I might go all in again. Okay, so this is my point. My point is, if let's say you have an account that is below 30, 40, 50,000, any account, anything below 50,000, because I want to be very conservative here. Okay, anything below 50,000, don't go buying ETFs and any ETF or any very conservative stocks, any um, dividend stocks that doesn't have any high growth potential. Okay, put your money in high growth stocks. Pick one or two stocks. Buy 20. If let's say your account is 50,000, buy 25,000 each of one or two stocks. You know, 25,000 of Google, 25,000 of Robinhood, or 25,000 of Amazon, and 25,000 of buy high growth stocks. Don't be buying ETFs. And I'll explain it later. I'll show you something real quick. Dividend stocks are really good to maintain and diversify your money. And if you are on the reason why I'm giving the age as 47 and below, because if you are getting to retirement, you really want, to diversify your portfolio. You don't want to be losing or you don't want big swings in your account. But if you want to grow a portfolio, you have 10,000. I've seen people with $10,000 and have $5,000 in SCHD. Homie, your account is not going to grow. Your account is just going to stay the same. Every year you're gonna have 5%, 6%, and you have to wait for the next 40 years. I'm not in the mood to wait for the next 40 years. People go like, oh, the power is compound interest. Yeah, you gotta wait 40 years to spend your money. By that time, you can't be sitting riding a gondola in Venice. You'll be asleep in that freaking gondola. Okay, I can't wait 40 years, 50 years to retire. I don't want to do that. I want the latest I want to retire is by the age of 50, where I have some strength in me and can still travel around the world and do good stuff. SCSG going to sustain your money. That $10,000 that you have SCHG is just going to sustain. It's not going to grow it. I'll show you from somebody who has SCHG. Okay, I have 268 shares. This is me being completely open. I have 268 shares of SCHG. It's what, $8,000 market value right now. Is 7.6% of my portfolio. So SCHG, and the reason why is because, like I said, I'm over 100,000 in a portfolio. I want to remain diversified a little bit. If I find a company that I think is very high growth, I'm going to sell all this and put the money in that company. And then when I get my profits, I'll buy SESD back. Buy high growth stocks. And then when you get the profit from the high growth stocks, you can use the profit to buy SCSD. And then that is going to keep working for you whilst you still continue to chase high growth stocks. Don't be putting, you have $5,000. And what are you protecting? 5,000, 5 grand? Come on. Take freaking high risk. Look for 5 grand, look for two companies, right? That are going to, you think, okay, this is a sure thing that is going to look at. Don't you can do pharmaceuticals. Pharmaceuticals are amazing if you know what you're doing, right? But don't go and put all your money in pharmaceuticals or penny stocks. They are amazing if you know what you're doing, but if you don't know what you're doing, they're going to bite you up in in the ass. Great companies, Google, Amazon. And the reason why, I tell people this and I show people all the time, I'll show you something right now. I went to Google, did a 1 year comparison of the stock performances between SCHD, Robinhood, and Google. This is the past 1 year. Okay. So the past 1 year. So based on, and I'll just read all these for you based on the performance data from early 2026. Robinhood and Alphabet, which is Google, have significantly outperformed SCHD over the past year. So Robinhood and Google they have significantly performed SCHD in the past 1 year. So if you have money and you are keeping it in SCHD, you're losing a lot. you're losing a lot of money with Robinhood leading in raw price appreciation and Google showing massive gains driven by AI, while SCHD provided lower volatility and dividend growth. That's true, lower volatility. So your account is just going to remain the same and your dividend is going to grow, which is the dividend is about 3%. It's 3%. Come on. If you have, $10,000 in that account, you're going to get $300 by the end of the year. That's 3% dividend. If it grows, I mean, it grew a little bit. Let's say it grew 10%. So you're going to get, 1,300. But in the last 1 year, look at how Robinhood grew. Performance from Robinhood. Robin, Robinhood has experienced massive volatile growth, with some reports showing total returns over the past year exceeding 70 to 100%. 100%. So let's take the lowest end of it, 70%. So if you put $10,000 in Robinhood in the last year, you had 17,000. That means you got $7,000 growth. Whilst SEHG, you'll be having 1,300. Let's say 1,500. So if you did that, you have 7,000, you take that 7,000, right, profit, go buy SCSG and still use that 10,000 to be chasing after high growth stocks. That's what you do. You don't go and put your initial investment 5,000, you put in SCHC. You're not going to get anything out of it. Don't buy SCHC, please. Do not buy SCHD. Okay. I'm not going to read the drivers and the, anything about. I'm just going to read the quick, performance of all both of the companies that we chose, right? Google delivered strong gains with reports indicating a 1 year return of over 60%. Let's just say 60%. If you put $10,000 in Google last year, as of today, you have a profit of $6,000 compared to 1,500, of SCSG. you know a lot of these growth There's a lot of growth stocks in the market, great companies, like solid companies, Meta and Netflix. That's the fangs, or how do they call it, the big seven, whatever the name is. You can always go into those places and make some money. Nvidia had some tremendous growth. You don't have to be like a big sniper to pick out those stocks. You can just watch the market trends and get those stocks and put your money where you think it's going to grow. You don't, I'll show you Google. Strong performance in 2026 was fueled by acceleration in Google Cloud AI monetization, robust search advertising revenue, leading to a 4 trillion, plus market cap by early 2026. you there's some, tech security, companies that did pretty well. There's some chips that did pretty good. Nvidia, AMD, all those companies did high growth. Stocks did pretty well. Why are you chasing after SCHC when you just have $10,000? Do not buy SCHC, please. Please. So we're gonna do it real quick. Hood very high, the performance 70% to 100%. Google also high, 60% plus, and SCHD moderate, 12% to 15%. You think it's a good percentage for you? If you're not a risk taker, you're not gonna go anywhere with your $10,000. Yeah, you're gonna grow it $1,500 a year at a time, but you're going to be 76 before reaping your freaking, compound interest thingy that you want to generate from 76. Yeah, of course, your money is going to stay stable, but you're going to reap it at 76. Or you can go with Google and Robinhood and all these high performance stocks, and then by 50 you can retire and still go to Thailand, and still go to, Japan, still go to wherever you go to Europe, go to South America, go wherever you want to go to, and have your account work for you, have money work for you. Why are you sitting on 15%, you know dividend stock when you can get a 60% or a 70 to 100% high growth stock? Forget SCHD and buy high growth stocks. When you get the profit, always take profit. When you get some profit, sell it, put the money, put it in an SCHD. Just like me, I did the same for my portfolio. I had Palantir, I had Google, I had all these companies. And then when they started doing really good, I sold a lot of my Palantir and put it in SCHD. Most of the profits that I got in Palantir, I put in SCHD. So please be smart when it comes to money, and do not buy SCHD, please. Okay, not to waste too much of your time. I hope you have a great day and be safe. Peace.